Okay, I think we are live. Hello. Good evening, and welcome to a very special session where we discuss the Union Budget 2026. My name is Govind Singh, and this session would be regarding the Union Budget in English. The discussion would be happening primarily in the English language. In case you want to attend the discussion in Hindi, there is a simultaneous stream which is going on the channels which you can also attend. So let's start off our discussion. Please let me know in the chat box if I'm clearly audible and visible to all of you. And I would also recommend that you guys sit with a notebook, a pen and paper, so that you can make notes throughout the session. This one is going to be a long haul. So grab some water, grab your pen and notebook, grab popcorn, whatever you want to munch along. And then let's begin today's discussion. Just give me a yes in the chat box very quickly if you are live on the stream. If you are able to hear me, see me. I can see Anirudh. Anirudh says, read your email. Will do as you say. You're most welcome. I hope that helped. Okay, ciao. Let's begin our discussion for the day, Union Budget 2026. Now, first of all, it's important to establish why is the budget such a big deal? Why is there so much buzz around it? Most importantly, it outlines the strategy which the government has for the economic growth of our country. Second of all, it impacts us directly as well as indirectly. Some things might impact you directly, some things might not, but overall, it definitely concerns all of us. And last and the most important for what we are here on today's stream is it is exam relevant, be it the UPSC exam, be it the CLAT exam, be it MBA entrance exams. Budget is always a high probability topic, and you can expect questions any year from the budget or the economic survey. So it's important to definitely cover it in detail. Now we'll start off with a very quick question, an MCQ question, little trivia. The budget as a term is not officially mentioned in the constitution. That's not the legal term which we use in our Indian constitution. What is the actual term which is mentioned in the Indian constitution, which defines the budget? We have four options. Quickly, answers in the chat box, please. Swara is here. Good evening, Swara. B, annual financial statement. That's the right answer. Absolutely correct. The annual financial statement is what we call it. Now that we have understood it's called the annual financial statement, can you guys also quickly tell me the article? Which article of the Indian Constitution talks about annual financial statement? We've discussed this in one of our previous discussions for people who are regular on the channel. Absolutely right. This is Article 112, option number A. This is how the Constitution defines it. It is how the government plans the next financial year. Now let's start talking about this year's annual budget, the Union Budget. Now a highlight which was special to this budget was it was the first budget prepared in Kartavya Bhavan. Now what's the Kartavya Bhavan? This is just a building which you can see in the picture on the right hand side, and on the text box on the bottom left, which is Kartavya Bhavan, is simply a common central secretariat, a complex of 10 newly constructed government buildings in New Delhi developed under the Central Vista Redevelopment Project, and it is being used as offices for various ministries. There were some older buildings like the Nirman Bhavan, etc., which are being replaced, and Kartavya Bhavan is one of such buildings. Now, our finance minister said that this Kartavya Bhavan, as the budget was created in the Kartavya Bhavan, we are inspired by three kartavyas. Kartavyas essentially translates to duties in simple words. What are the three kartavyas? What are the three duties? The first one is to accelerate and sustain economic growth by enhancing productivity and competitiveness and building resilience to volatile global dynamics. We all know geopolitics is going a little shaky these days, be it statements by Donald Trump, be it the Israel-Gaza conflict, be it the Russia-Ukraine conflict, be it the Sudan conflict, and so on. So to tackle these conflicts and still grow resiliently, that is one of our kartavya. Then the next one is aspirations, fulfilling the aspirations of people and building the capacity which makes them strong partners in India's path to prosperity. And the third one is aligned with our vision of Sabka Saath, Sabka Vikas, to ensure that every family, community, region, and sector has access to resources, amenities, opportunities. So these are the three kartavyas. Have to remember them. Okay, now moving forward, now India's economic trajectory has been defined by the statement Viksit Bharat, balancing ambition with inclusion. Inclusion means taking everyone together. Ambition, we all know. Viksit Bharat is developed India. And we have a goal year, target year as well for Viksit Bharat. What is the target year? Can you guys quickly tell me in the chat box what is our target year for Viksit Bharat? And we have three other phrases which have been used by our finance minister. First one is action over ambivalence. Ambivalence is being confused on what to do, this to do, what not to do. And we are taking action over ambivalence, over thinking, reform over rhetoric, people over populism. Populism is simply, taking an approach which appeals to the masses. And our aim is to transform aspiration into achievement and potential into performance. And these are the four blocks for this: stability, fiscal discipline, sustained growth, and moderate inflation. Can you guys quickly tell me what is the ideal range for inflation? For people who have studied economics, might definitely know this. What is our ideal inflation range? Some sort of inflation is good for the economy. What is that range? Let me also have a look at the chat box. 2047 is the right answer for Viksit Bharat. Absolutely correct. Shaurya is here. Hello, Shaurya. Okay, cool. So the next aspect is the high growth rate of around 7%. We want to maintain this GDP growth rate of 7%. And there are a few things which are important for this: energy security, domestic manufacturing, reduced critical import dependence, citizens benefiting from government actions, strong thrust on public investment, monetary stability, fiscal prudence, far reaching structural reforms. You don't have to remember this. This is just an outline of it. Now, what is important for us is understanding that this one is a Yuva Shakti driven budget. Yuva essentially stands for youth, Shakti is power. So, the power of the youth, that is what drives this budget. That is the government's Sankalp. Sankalp is essentially resolution. And the resolution is to focus on poor, underprivileged, and disadvantaged. And again, you are highlighted with the three kartavyas: the first kartavya, second kartavya, and third kartavya, which we already discussed on the first slide. So we move to the next aspect of this budget. Now, there are multiple terms which have been used by the finance minister here, like robust and resilient financial sector, sustaining the momentum of reforms, cutting edge technologies. These are basic, broad terms on which we want to take action. And India's Reform Express has certain pointers in mind, which is undertaking comprehensive economic reforms to create employment, boost productivity, accelerating growth. 350 reforms, including GST simplification, labor codes, quality control orders, high level committees, deregulation, all of these things. So, this is more of things happening on a generic level, on a general level. We'll get into the specifics. Hold on for that. But right now, we are establishing the agenda on what exactly is the budget focusing on. And this is the most important slide out of that, because this tells us about the 5 pillars which the budget has focused on. What are the 5 pillars? Rather, 6 pillars, I would say. Sustaining economic growth, this is the first pillar. Strengthening the foundations of growth, then people-centric development, trust-based governance, ease of doing business and ease of living, and finally, fiscal matters. We'll go through all of them one by one, explore all the intricacies which have been discussed in the budget. We start off with the first pillar, which is sustaining economic growth, which begins with the manufacturing sector. Now, what are we focusing on in the manufacturing sector? The first thing is India Semiconductor Mission 2.0. So 1.0 was already launched a few years back. Now we are stepping it up with another initiative, which is 2.0. This is to develop semiconductors in India and to increase our capacity of semiconductors. Then you see Biopharma Shakti. This essentially means establishing and consolidating more pharmaceutical infrastructure so that we can tackle diseases more efficiently. We can have more hospitals, we can provide healthcare to citizens. Then you have high-tech tool rooms in CPSEs. CPSEs are just central public sector entities. Scheme for rare earth permanent magnets research, mining, manufacturing, processing. Scheme for container manufacturing, dedicated chemical parks. Program for textiles, electronics component manufacturing scheme, manufacturing of sports goods, revival of industry clusters, and strengthening domestic manufacturing of advanced construction equipment. So these are some things on which our manufacturing sector is going to focus upon. Then there are also tax reforms to boost our manufacturing sector. Now, this might get slightly technical, but bear with me here. We'll try to simplify it as much as possible. You don't have to remember all of this. What's important is a more overall, broader, holistic understanding of what are things happening. What are the things happening? Exemption from income tax for 5 years to non-residents, NRIs, providing capital goods, equipment, or tooling to any toll manufacturer in bonded zone. There are multiple business zones: bonded zone, economic zone, special economic zone. Provision of safe harbor to non-residents for component warehousing in bonded warehouse. Deferred duty payment window to trusted manufacturers. Then duty-free imports of certain items. Duty-free imports of specific inputs. Extension of time of exports. Basic custom duties exempted. Then regular importers with trusted supply will be recognized in the system. Electronic sealing, special one-time measures for SEZs, which are special economic zones. So these are the things which we are doing on a tax level to make manufacturing more smoother. The next thing which we look at is equity support. What do we mean by equity? Equity is government providing the funding. Who are they providing funds with? This is an SME growth fund, small medium enterprises growth fund, and they have dedicated 10,000 crore for this, and they have topped up the self-reliant India fund with another 2,000 crores. Apart from that, professional support. They are going to facilitate professional institutions to develop corporate mitras in tier 2 and tier 3 to help MSMEs meet their compliances. Then the tax proposal is removal of current value cap of 10 lakh per consignment on courier exports. The third approach is liquidity support to TREDS. Now, what is TREDS? I have put a screenshot here. This is Trade Receivables Discounting System, which is nothing but a platform made by RBI to help MSMEs in working their accounts. Let's put it very simply. Right. So they would be providing more liquidity support through trades itself and also link it to GEM. What is GEM? Can anyone tell me in the chat box? What is GEM here? GEM? What does GEM refer to? Now, we talked about micro, small, medium enterprises. Let's also understand them a little bit in detail. MSMEs are classified on criteria of either investment or turnover. So if your investment is less than 1 crore and turnover is less than 5 crore, you are a micro establishment. If your investment is less than or equal to 10 crore, turnover is less than or equal to 50 crore, you're small. If less than equal to 50 crore, is investment, less than equal to 250 crore is turnover, then you are a medium enterprise. So this is how the definition of it goes about. And these form the backbone of our country because they contribute almost one third, 30% to India's GDP and 45% to our manufacturing output, employ over 60% of the workforce to 90 million people. So yeah, these are some stats on why MSMEs are super duper important. Now we move to the second aspect of the first pillar, which is renewing the emphasis on the services sector. Service sector is different from the manufacturing sector. Here you focus on employment and enterprise standing committee to focus on service sector as the core driver of Viksit Bharat. And on the health front, we are going to set up new institutions for allied health professionals in 10 disciplines. You would be developing NSQF aligned programs to train 1.5 lakh multi-skilled caregivers. Then schemes to support states in establishing 5 hubs for medical value tourism. India is known for medical tourism. A lot of people come to India to get their treatments. Then 3 new Ayush institutions: All India Institute of Ayurveda, upgrading to Ayush pharmacies and drug testing labs for higher standards, and upgrading WHO, Global Traditional Medicine Centers as well. So this is what we are doing on the service sector. Continuing with that, we are also setting up AVGC content creator labs in 15,000 secondary schools and colleges. AVGC stands for audio visual graphical content, and this is also called the orange economy. This might be asked. This is a simple one liner. We're also setting up a new National Institute of Design through challenge route in the eastern region of India, and we're also supporting the Khelo India mission to support sports infrastructure. Now, AVGC, as we said, animation, visual effects, gamings, and comics. Okay, that AVGC is different, which I said. Cool. So this is what we are focusing on: content creators in these particular fields: animation, visual effects, gaming, and comics, including extended reality as well. Okay. Next up is education. What are we doing on the education front? We are making 5 university townships near industrial and logistic corridors, girls' hostel in every district, setting up telescope infrastructure facilities, 4 such facilities, setting up a National Institute of Hospitality to serve as a bridge between academy, industry, and government, pilot scheme for upskilling 10,000 guides, destination national destination digital knowledge grid to document all places of significance, then develop mountain trails, turtle trails, bird watching trails in states. India to host the first ever global Big Cat Summit as well. How many big cats do we have? Okay, let's put it this way: how many species are matter of concern for the Big Cat Alliance. International Big Cat Alliance is an organization. So how many big cats essentially? You can tell me that. Then we have developing 15 archaeological sites into cultural destinations, developing Buddhist circuits in the Northeast region. So this is what we're doing for education and tourism. And related to the service sector, again, just like we had tax reforms for the manufacturing sector, we also have tax reforms for the service sector. Now, I'll try to make this as simple as possible. Let's first read these particular pointers and then I'll explain the terms which have been used here. Clubbing of services under single category of IT services with a safe harbor margin of 15.5%. What is safe harbor margin? Come here, downside. Safe harbor margin is a predefined acceptable operating profit margin set by tax authorities for international transactions to avoid transfer pricing audits. Now, what are transfer pricing audits? Now come on the top. Transfer pricing is setting of prices or goods or services exchanged between related entities of a single parent company within a MNC. So, for example, let's say there's a company called Eternal, which is the head company of Zomato, Blinkit, and other companies. Now, as Blinkit has to buy something from Zomato, or Zomato has to buy something for Blinkit, they would set a particular price. That is what transfer pricing is, right? So that is what is happening. A safe harbor margin of 15.5% has been fixed. Earlier, it was between 15.5 to 24%. Then you have safe harbor threshold for IT services increasing from 300 crores to 2000 crores. So this margin threshold has also been increased. Then you have approval of safe harbor for IT services by automated rule process, continuation of safe harbor for 5 years, fast tracking unilateral APA process for IT services. What are APAs? APAs are advanced pricing agreements, contract between a taxpayer and tax authority that sets the transfer pricing, how prices are set between international transactions. Now, why this is important? This is important to avoid double taxation. Let's say a company has an entity in India, also has an entity in Dubai. If they've already paid tax in India, they won't want to pay tax in Dubai. So to avoid double taxation, you have these pricing agreements of transfer pricing between entities of a similar company. So they are fast tracking unilateral advanced pricing agreements process for IT services, basically increasing ease of doing business so that India can export more of its services to other countries. Extension of facility of modified returns for APA availing entities. Provision of tax holiday until 2047 for foreign companies providing cloud services to global customers through India-based data services. Then exemption of global income to a non-resident expert for stay period of 5 years. So these are tax reforms related to the service sector. You don't have to understand it in complete depth, but you just need to have some context on what exactly is safe harbor, what is transfer pricing, what is advanced pricing agreement. And because these things are not mentioned in the budget document, also not explained by the finance minister, of course, it's important that we do it here. Next up, we move to the financial sector. Manufacturing is done, service sector is done. We move to the financial sector. Here we are setting up high-level committee on banking for Viksit Bharat, where we are issuing incentive of 100 crore for issuance of municipal bonds of more than 1000 crores. And the current scheme will continue under Amrit scheme. Amrit scheme kya hai? What is Amrit scheme? Atal Mission for Rejuvenation of Urban Transformation, a national initiative aimed at enhancing urban infrastructure and ensuring basic services. This is what the Amrut scheme is. So it's getting intensified. Then you have restructuring of Power Finance Corporation and Rural Electrification Corporation. Then you have a review of the FEMA Act, which regulates foreign exchange, foreign currencies, etc. Then you have introduction of market making framework for total return swaps on corporate bonds. This is slightly technical, would take a little longer to explain. You can skip this. Corporate bonds are sort of an investment instrument, and swaps is also one of the things linked to it. Okay, next up we have increasing farmers' income by enhancing productivity in agricultural and related sectors. What are we doing for that? We are doing Bharat Vistar, which is integrating agri-stack portals and packages on practices with AI systems. We are focusing on cultivation and processing of sandalwood, जिसको हम हिंदी में चंदन कहते हैं. Then we are focusing on fisheries. We are developing 500 reservoirs and strengthening the fisheries value chain. We are focusing on cashew and cocoa, boosting engagement by aligning training. Then we are supporting high value agriculture like promoting coconut scheme, then Indian cashew and cocoa programs. Then we are also working towards animal husbandry and supporting entrepreneurship in these particular sector, providing them capital, etc., and dedicated programs for horticulture to rejuvenate our orchards and high density cultivation of walnuts, almonds, and pine nuts, which are dry fruits. Now, what are the tax proposals related to these particular initiatives? Fish catch by an Indian fishing vessel in EEZ or high seas have become duty free, treating the land of such fish of foreign export as export of goods. Deduction allowed to primary cooperative society engaged in supply of cattle feed, allowing intercooperative society dividend income as deduction, exemption from tax dividend, essentially tax benefits to people working around fish culture. EEZ क्या होता है? What is EEZ? Exclusive Economic Zone. This is a maritime area where with a coastal nation has special rights over explosion. So, for example, this is, let's say, India's southern boundary. So, an area of 200 nautical miles. This would be exclusive economic zone for India, where we have the right for fishing, exploiting marine resources like fish, oil, wind energy, 200 nautical miles from the shore. This is defined by the UN Convention on Law of the Seas, UNCLOS. Now, the first pillar is done, and we move to the second pillar of our budget, which is strengthening the foundation of growth. And the first part is infrastructure. For infrastructure, we are launching various initiatives and large scale enhancements of public infra like INVITs, REITs, NIIFs, NABFITs. I'll explain all of these, don't worry about it. Continue to focus on developing infrastructure in cities with over 5 lakh population, which is tier 2 and tier 3 cities. As you can already see, our public capex has already increased. Capex stands for capital expenditure related to infrastructure, which helps the public. So it could be parks, it could be street lights, etc., etc. So that has increased from 2 lakh crore in financial year 15 to 12.2 lakh crore. That's the target for financial year 2027. Coming back to what are invites, REITs or REITs, NIIFs, and NABFID. Now, REITs or Real Estate Investment Trust and Infrastructure Investment Trusts are investment vehicles. Investment vehicles means that this is a way to invest in property without actually buying property. So you can buy a part of the property, you can buy a share in the property without actually deploying a lot of capital. Both are regulated by SEBI, listed on stock exchange, and it's mandatory to distribute at least 90% of their taxable income to unit holders. Difference between REITs and invitees, if you're interested, we can go through this focuses on commercial real estate, REITs, and they crossed 1 trillion in market cap, whereas INVITs is 6.3 lakh crore, which focus on infrastructure projects. So you can also invest in roads, telecom towers, pipelines, etc. And once the price increases, the value of these REITs and INVITs increases, and then you can cash out and sell it on the market. So that is how it works. Now, NII, what is this? This is a fund, National Investment in Infrastructure Fund. This was established in 2015 by the government to attract capital for infrastructure development. And INVITs is sort of like a tool which furthers this particular process. With over almost $5 billion in assets under management, it manages funds like master fund, private markets fund, different types of funds. Okay, next up we have NABFID. This is National Bank for Financing Infrastructure and Development. So this one is a fund, this one is a bank, and these two are investment instruments, you could say. Okay, let's move ahead. Then the next step in infrastructure development is multiple other things which we are doing on the infrastructure front. First up is setting up infrastructure risk guarantee fund to provide prudently calibrated partial credit guarantees to lenders. Then we are recycling real estate assets of, again, central public service entities through setting up of dedicated REITs, establishing dedicated freight corridors. Freight is transport of goods, connecting Dankuni in the east to Surat in the west, operationalizing 20 new waterways, national waterways, connecting mineral-rich areas. Waterways would essentially be transport through rivers. Setting up ship repair ecosystems, catering to inland waterways, launch a coastal cargo promotion scheme to increase the share of inland waterways, launching a seaplane VGF scheme to indigenize manufacturing, 2 lakh crore support to states under SASCI scheme. We'll discuss all of this. Then Purvodaya initiative, which is for development of East Coast Industrial Corridor. Starting off with the one which we discussed here, the dedicated freight corridor, Dankuni in east to Surat in the west. Here you can see Surat, here you can see Dankuni in the east. So this is how a corridor would go. Then you have the different dedicated freight corridors which are already present. These are some of them: the red line, the yellow line, the blue line, the green line, the purple line, and the violet line, pink line rather. And these connect various regions which are important for trade, manufacturing, etc. Next up, we have what exactly do we mean by national waterways? So essentially, connecting different places through rivers. We also have National Waterway 1, National Waterway 2, National Waterway 3. The National Waterway 1 connects Prayagraj to Haldia. This is through the Ganga River. National Waterway 2 connects Sadia to Dhubri. This is through the Brahmaputra River. And then we have Kollam Kottapuram stretch. These are smaller canals. So similarly, we are developing 20 such national waterways across the country, which would then obviously improve our logistics and transportation. Then we are also developing an East Coast Economic Corridor. This is how it would look like, starting off from Kanyakumari going up till Kolkata. Phase 1 would be Visakhapatnam Chennai corridor. Phase 2 would be Chennai Kanyakumari corridor. And the phase 3 would be Odisha West Bengal corridor. And this would run along the entire eastern coast. And a multimodal regional corridor would be made. Now, what was the SASI scheme? This is SASCI, Special Assistance to States for Capital Investment. Development of iconic tourist centers to global scale. This is a tourism ministry initiative where center would be providing 100% funding to 40 plus tourism sites to develop them as world-class destinations. So that is SASI scheme. You just have to remember related to tourism. Okay. Now, the next aspect in this is ensuring long-term energy security and stability. Here we are coming up with a scheme to adopt carbon capture utilization, exemption of BCD on import of sodium antimonate, exemption on BCD on multiple things like capital goods for critical minerals, capital goods for manufacture of lithium ions, then custom duties for nuclear power projects. You all remember the Shanti bill, exclusion of entire value of biogas from central excise duty. So essentially, we are reducing taxes on these things which we are importing. What is BCD? BCD is basic custom duty. Custom duty is a tax which you have to pay for things which are imported into India. As per the Customs Act, can be anywhere between 5% to 40% based on the item. That is BCD, basic customs duty. Okay. Now, the next step is urbanization, city economic regions, amplifying the potential cities to deliver the economic power of agglomerations, focusing on tier 2 and tier 3 cities and temple towns, and also developing 7 high speed rail corridors. So, these would be train corridors where these cities would be connected by high speed trains. What are these corridors? Mumbai, Pune, Pune, Hyderabad, Hyderabad, Bangalore, Hyderabad, Chennai, Chennai, Bangalore, Delhi, Varanasi, Varanasi, Siliguri. Mumbai Ahmedabad bullet train project is a part of this. A high speed rail corridor is a dedicated railway route for passenger trains running on speeds above 250 kilometers per hour or higher, or upgraded tracks running at 200 kilometers. So that is what it is. Now, second pillar is done. We come to the third pillar, which is people-centric development. What are we doing here? Here we are doing multiple things, building a care ecosystem with geriatric care, which means care for senior citizens, self-help entrepreneur marts to be set up at retail outlets, then Divyangjan Kaushal Yojana to provide dignified livelihood to industry-relevant people who are disabled, then Divyang Sahara Yojana for high-quality assistance devices to Divyang people who are disabled people. Then supporting Artificial Limbs Manufacturing Corporation of India, strengthening PM Divyasha Kendras. These are the PM Divyasha Kendras initiative by Social Justice Ministry to provide free of cost assistance to Divyangjan and senior citizen for assessment, distribution of aids, rehab, etc. Setting up NIMHANS, this is National Institute for Mental Health. This is gonna be set up, and institutes in Ranchi and Tezpur are also coming up. Then emergency and trauma centers in district hospitals. This is the third player. People-centered development. The fourth pillar is trust-based governance. Now, this has slightly technical things, but nothing too difficult. Enhancement of duty deferral period for tier 2 and tier 3 authorized economic operators from 15 to 30 days. इससे हुआ क्या? Eligible manufacturer importers will get the same duty deferral facility. Government agencies will be encouraged to leverage AEO accreditation, basically making business easy for manufacturers, importers, etc. by increasing the time in which they can defer their duty. Transformation of customs warehousing framework into a warehousing operator centric system, filing of bill entry by trusted importer, extension of validity of advance ruling binding on customs. Regular importers with trusted long standing supply chains will be recognized in the risk system. So essentially, government is wanting that you trust the government would trust you. And for that, they would be willing to give you certain concessions, certain extra benefits and facilities. The fifth pillar is ease of doing business and ease of living. Now, here we have multiple things again, important things though. The first thing is individual person resident out of India, PROIs, will be permitted to invest in equity instrument of Indian companies through portfolio investment schemes. So a person who is, let's say, resident of India but living in US can invest and purchase, let's say, Reliance stocks. Interest awarded by motor accident claim tribunal to a natural person will be exempt from income tax and any TDS. TDS is tax deducted at source on this account will be done away with. Reduce TCS rate on sale of overseas tour program package from 5% and 20% to 2% without any stipulation of amount. So the overseas tour packages would become cheaper. So you can probably go on a foreign trip at a much lower cost. Now TCS is tax collected at source. So the company collects this tax when you pay for it. Reduce TCS for pursuing education and for medical purposes under the liberalized remittance scheme. Remittance is essentially money which comes back from people who have left the country. TDS on supply of manpower services to be at the rate of either 1% or 2%. Obtaining a lower or nil deduction certificate for small taxpayers. Enable depositories to accept Form 15G, 15H for taxpayer holding securities in multiple companies, essentially making things easier for people who are investing in the markets, people who are honestly paying their tax. Time available for revising income tax returns has been extended till 31st March with the payment of a nominal fee. And people with ITR 1 and ITR 2, the return filing date is 31st July. Non-audit business and trust, 31 August. Usually ITR 1 and 2 are for salaried employees. Then you have a few more points. TDS on the sale of immovable property by a non-resident to be deducted and deposited through the resident buyer's PAN instead of TAN. Introducing 1 month, one time 6 month foreign asset disclosure scheme below a certain size for small taxpayers. So, for example, let's say you have unauthorized money, illegal money, black money. With that, you have illegally purchased foreign asset, let's say a property, a villa in Dubai using cryptocurrency, let's say. So you have a one time 6 month window to disclose that, but that too for a certain size for small taxpayers. So government is wanting you to be honest and, trust them, and in return the government would trust you. Allow taxpayers to update their returns even after reassessment proceedings have been initiated at an additional 10% tax rate. Framework for immunity from penalty and prosecution in cases of underreporting extended to misreporting. So for example, many people have a, let's say, higher income, let's say 1 crore, and they reported only 50 lakhs as income. So for that, you are not really charged in a criminal case, but if you misreported, then you would have been charged for criminal cases. And now the immunity has been extended to even misreporting. Non-production of books of accounts and documents and requirement of TDS is also decriminalized. So a lot of financial related offenses have been decriminalized, which means they are not a criminal offense anymore. Immunity from prosecution with retrospective effect for non-disclosure of non-immovable foreign assets with an aggregate value of less than 20 lakhs, essentially things which you have purchased illegally but less than 20 lakhs. Exemption from minimum alternate tax to all non-resident who pay tax on presumptive basis. Presumptive basis means you presume that you would make such income in a particular year, and on the basis of that assumption, you pay a certain tax already. And for non-residents, the minimum alternate tax has been exempted. What is minimum alternate tax? We'll come to that in a minute. Constituting a joint committee under Ministry of Corporate Affairs and CBDT in the Indian accounting standards, tax buyback for all type of shareholders as capital gains, but promoters will pay an additional buyback tax. Buyback is essentially a technique used by people to reduce their tax liability. Investors are the primary beneficiaries of this. Set off using available MET credits to be allowed to an extent of one-fourth of the tax liability in the new regime. MAT is proposed to be the final tax. Exempt basic custom duty on 17 drugs or medicines for cancer patients. Now, what are METs? Let's discuss that first. MAT is a minimum alternate tax, a provision under Income Tax Act designed to ensure companies pay at least a minimum amount of tax. Because a lot of companies, what they do is they structure their books or their accounts in a manner that it shows that no tax is due. And to ensure company pay little to no tax due to exemptions and incentives, but still pay a minimum amount, the government has mandated कि 15% tax would apply on book profits if normal tax liability is lower. So this is the minimum alternate tax. If your tax liability is coming to zero, you would still have to pay 15% tax on book profits. That is minimum alternate tax. And from that, NRIs have been exempted. And the credits which were available to set off this, that has been extended. Single and interconnected digital window for cargo clearance, custom integrated system. Honest taxpayer willing to settle disputes will now be able to close cases by paying an additional amount instead of penalty, because penalty is usually very high, usually 3 times, 4 times of the amount which you have, let's say, not disclosed or not paid tax on. But now you can just pay an additional amount instead of the penalty. So the government wants you to disclose whatever shady things you have done. And the last pillar, the sixth pillar, is the fiscal matters. Now, the 16th Finance Commission recommendations have been accepted, and as per that, the vertical share of devolution would be 41%. What is devolution? Devolution is the amount of tax collection or revenue which the central government shares with the state government. So, devolution is, let's say, allocating a particular share of central government's money to state government. Now, what is vertical devolution? Two types of devolution. Vertical, which means the center allocating a particular amount. Let's say the center has 100 rupees. Now the center is willing to give 41 rupees, as it is mentioned, 41% to the state government. So 41 rupees directly, vertically goes to the state. Now how this would be distributed among the states, that is horizontal devolution, on, let's say, UP getting 10 rupees and MP getting 6 rupees and so on. So vertical devolution is center to state, horizontal devolution is within the states. And vertical devolution is 41%. Provision of 1.4 lakh crore to the states for financial year 27 as financial commission grants, which includes rural and urban local bodies and disaster management grants as well. Now, talking about fiscal consolidation, this is slightly technical, some words which economic students would better understand. But still, let's see. Central government will target reaching a debt to GDP ratio of 50 plus minus 1% by 2030. Debt to GDP ratio, as the name suggests, how much the government has debt and what is our GDP. Debt divided by GDP. That is the debt to GDP ratio. Debt to GDP ratio is estimated to be 55.6% of GDP currently, compared to 56.1 in the previous financial year. In RE 2025, the fiscal deficit has been estimated at par with BE of 2025. In line with new fiscal prudence, the fiscal deficit is estimated to be 4.3%. We'll talk about these terms in the later aspect of the PPT as well. Now, these are some trends which have been issued, the deficit trends. Fiscal deficit has grown over the years. Revenue deficit has grown over the years. Primary deficit has grown over the years. Effective revenue deficit has also grown over the years. These are percentage of GDP. So fiscal deficit as of now is 6.5% of the GDP. Revenue is 4%. Primary deficit is 3%, and effective revenue is 2.8%. Let's try to understand all of these terms. First up is the fiscal deficit. The fiscal deficit is the difference between total revenue and total expenditure of the government. How much did the government earn? How much did the government spend? The difference is fiscal deficit. If the government earns more and spends less, then that would be fiscal surplus, but that never usually happens. Usually the government earns less and spends more, and therefore there is a deficit created. There is a difference created, and that is what we call as the fiscal deficit, which indicates the total borrowings that may be needed by the government. Because if income is, let's say, 100 rupees, but spending is 200 rupees, where would the extra 100 come from? Borrowing. So this fiscal deficit tells how much the government has borrowed. Simple. Now, what is the next one? Revenue deficit. Revenue deficit, effective revenue deficit, is a fiscal metric which refines the conventional revenue deficit by subtracting grant in aid. So revenue deficit is your revenue grants for creation of capital assets. Revenue deficit minus grants for creation of capital assets. So yeah, that's this. Then there is primary deficit, which is fiscal deficit minus interest payments. So the interest on the loans which the government has taken. Now, when you look at the government's accounts, government has two types of accounts. One is the revenue account, one is the capital account. Revenue account has revenue receipts, revenue expenditures. Capital account has capital receipts and capital expenditure. What are revenue receipts? These are different type of taxes which the government has collected: direct taxes, indirect taxes, non-taxes, cess, duties, etc. Then revenue expenditure. What is the expenditure which the government has done on a day-to-day sort of a basis? Where has the money gone? Then there is capital receipts. These are loans raised and disinvestment. So capital comes to the government, right? Then there is capital expenditure, creation of assets and loans. Revenue account, if you talk about that, revenue receipts are income that does not create liabilities. This is economics 101. If you know this, then good. If you don't, it's pretty simple. Revenue receipts are income that does not create liabilities or reduce your assets. So, for example, tax income for the government, income tax, GST, all of this increases the government's income but does not create any liability. The non-tax revenue like dividends, fees, and fines, etc. Then there is revenue expenditure, expenditure for day-to-day functioning. No assets are created here. On capital expenditure, assets are created. Examples are giving salary to government employees, subsidies, interest payments, defense expenses. Revenue deficit is the difference between revenue expenditure and revenue receipts. How much did the government spend on day-to-day basis? How much did the government earn from all of these revenue receipts? The difference is revenue deficit, just like fiscal deficit. Then you have the capital account. Capital receipts are receipts that create liabilities or reduce your assets. So, for example, taking loans, recovery of loans given earlier, small savings. And capital expenditure is expenditure that creates assets. Construction of roads, purchasing machinery, defense equipment, etc., etc. And capital deficit is the difference between the two. Capital expenditure minus capital receipts. Now, this is a distribution, a pie chart given by the finance minister on where is our money coming from, rupee coming from where, which sources. So the major chunk, the biggest chunk comes from borrowings and liabilities. The second largest comes from income tax. Then you have corporation tax. Then you have your GST and other taxes. Then you have non-tax revenues. Then you have customs, excise duties, and then you have non-debt capital receipts. Now, where is rupee going to? What are these avenues? The largest amount is going to states' share of taxes. And the second largest is going towards interest payments on the loans which we have taken. Then the next largest is going to central sector schemes, the schemes which are completely sponsored by the center. Then the next aspect is going to centrally sponsored schemes and defense. Defense is the larger one. Centrally sponsored schemes are ones in which center contributes a certain percentage, a certain part, and the rest is done by the state. Then it's finance commission and other transfers. That is also where money goes. Civil pension, pension of government employees, other expenditures, 7%. Now, the last thing is looking at capital receipts and revenue receipts. As you can see, the capital receipts have grown, the revenue receipts have also grown. These are the income which is coming to the government. Then looking at capital expenditure, these have also grown throughout the time periods. Effective capital expenditure is the sum of capital expenditure and grants in aid for creation of capital assets. Last thing is expenditure of major items. Where are we spending the most money in terms of categories? Then transport takes highest precedence. Then we have defense, rural development, home affairs, agriculture, education, energy, health. These are in lakh crore, in crore rupees, sorry. So 5.98, 5,98,000 crore is the number. Then you have urban development, IT, commerce, social welfare, scientific departments, tax administration, external affairs, finance, etc. With that, we come to the end of our budget details. These are all the things which we look at in the budget. Under this saying, should we remember all the full forms or all the short form words? Short forms are fine. CLAT and other exams, MBA entrance exams, UPSC exams, these usually don't test you on full forms. But if you can remember, then that's good enough. Sure is saying what should be our primary focus in the budget. Primary focus should be knowing what are the new initiatives. The tax reforms are not very important for you, very less important for you, I would say. What you would focus on is, let's say, what are the new things being made, new, let's say, Ayurveda centers being made, new rail corridors being made, new waterways being made, new schemes being launched. So whatever is new, that is what you would focus on. So you can filter out using that criteria, or something which is relevant on a very national level. That is something which you can focus on. So that brings us to the end of our discussion for the Union Budget 2026. I hope this was useful. I hope this helped you understand the entire budget which was presented today by our finance minister for almost 1.5 hours. This document which I have used for these screenshots is also available online. You can just simply search Union Budget and you'll get the entire document to read if you want to read it. But yeah, we have covered all the important aspects. So that brings us to the close of this session. Thank you so much for attending and participating. I'll see you all in some other session. Take care. Bye bye.